Every few days, the financial headlines drop. The US is drowning in debt. The dollar is facing collapse. But if you are working, saving for your future, or planning for retirement, your actual concern isn't about macroeconomic headlines. It is about the safety of your bank account. To understand the risk to your money, we have to separate the deficit from the debt. The deficit is the government's spending gap over a single year. The national debt is the accumulated history of all those gaps, plus the interest owed. This chart shows the mathematical reality. If a household earns $100,000 but spends $120,000, they have a $20,000 deficit. Scale that logic up to the U.S. government, bringing in $4.4 trillion in revenue, but spending $6.1 trillion. That accumulated deficit leaves us with a $34 trillion debt block. If you divide that by 335 million Americans, the theoretical burden lands at over $101,492 for every single citizen. Congress frequently argues over raising the debt ceiling. Raising the ceiling does not cure the underlying financial disease. It merely extends the credit limit on a maxed-out card to avoid defaulting on payments already promised. Debt itself does not trigger an instant economic apocalypse. The structural danger materializes when continuous borrowing becomes a permanent dependency, shifting the heavy burden of repayment onto the future purchasing power of the citizens. So who lends the U.S. all this money? Huge pension funds, major domestic banks, and foreign governments. The United States does not borrow like a normal country. It borrows like an empire, leveraging the immense power of the global reserve currency. The principal amount of $34 trillion is massive, but it isn't the immediate trap. The true mathematical danger lies in the cost to service that debt, the interest rates. This chart shows the interest multiplier in action. At a 2% effective rate, the annual interest on the debt is a manageable $680 billion. But when inflation strikes and the Federal Reserve pushes rates higher, and that average toggles up to 4%, the interest cost doubles to $1.36 trillion. At 5%, it reaches $1.7 trillion a year. Rising interest costs displace funding for the rest of the federal budget. Every extra trillion spent servicing old debt leaves less space for productive areas like infrastructure, education, and national defense. This mechanic triggers the debt spiral. The government borrows money, interest accumulates, and the government must borrow even more money just to pay the interest on the previous debt. It operates exactly like paying off a credit card minimum with another credit card. To survive this without aggressively raising taxes, governments rely on financial repression. They engineer an economic environment where inflation runs hotter than the nominal yields they pay out, silently eroding citizens' savings to manage state obligations. Sovereign debt crises rarely arrive in a cinematic overnight crash. They act as chronic conditions, slowly eating away at the economy's vital organs and citizen wealth long before the public notices the damage. Will the United States default on its debt? Technically, a direct bankruptcy is highly unlikely because the government can always print the currency it owes. The primary risk to investors is an inflationary default. Inflation is the active, mathematically guaranteed destruction of your currency's core purchasing power. While it manifests as rising prices at the grocery store, the underlying event is the erosion of what each dollar can actually buy. This diagram outlines the Rule of 72, a classic financial calculation. If inflation runs at 6%, your purchasing power is cut in half in exactly 12 years. That $10,000 stack of cash suddenly buys only $5,000 worth of real goods. Apply that exact logic to a standard bank account. If your savings yield 2%, but inflation sits at 5%, your real return is -3%. The balance on your screen provides nominal safety. The number doesn't go down. But real safety is measured by the actual goods, services, and assets that number can buy in the real world. Bank accounts provide necessary liquidity for immediate emergencies, but treating cash as a long-term holding strategy provides only an illusion of safety while guaranteeing a mathematical loss of wealth. Massive financial systems can and do fracture under the weight of leverage and blind confidence, precisely as we saw during the 2008 financial crisis, when global credit markets effectively froze. Fast forward to the COVID era. Extraordinary fiscal interventions and money printing kept the system from collapsing, but the delayed consequences arrived in the form of deep consumer price inflation and a highly distorted housing market. Many assume a national debt crisis guarantees a stock market crash, but broad equities represent ownership in living businesses. Productive companies can raise prices and pass inflation costs through to consumers, allowing them to survive currency devaluation. This structural reality is why the S&P 500 matters. Despite clear vulnerabilities to short-term valuation risks and recessions, it functions as a highly diversified vehicle for long-term growth and inflation pass-through. Equities are not risk-free shields. But because they represent ownership in productive, revenue-generating assets, they are vastly superior to cash when it comes to preserving purchasing power across decades. This financial timeline explains how real estate functions as an inflation hedge. If you secure a $400,000 property with a 3.5% fixed mortgage, your monthly debt obligation remains flat. As inflation rises over the years, you pay off that fixed debt using progressively weaker future dollars. But real estate easily devolves into a liability. Variable interest rates, escalating property taxes, and severe maintenance costs quickly destroy that fixed payment advantage. Gold serves a strictly different function. It produces no yield and generates no income, but it acts as psychological insurance, a monetary mistrust hedge deployed against the fear of long-term currency debasement. Bitcoin is often argued to be mathematically scarce digital gold. While it shares some scarcity traits, its extreme volatility means it currently behaves as a speculative, risk-on asset, heavily reliant on adoption cycles. Bonds present a dangerous paradox in a debt environment. If you hold a long-duration bond with a low yield and stubborn inflation forces interest rates higher, the market value of your bond drops. Investors seeking pure safety often find themselves trapped holding depreciating paper. For those holding 401ks and IRAs, the immediate threat is sequence of returns risk. If the broader market draws down heavily right as you enter retirement and begin withdrawing funds, your portfolio mathematically struggles to ever recover the lost capital. No single asset class provides total immunity from a debt cycle. Protecting your capital requires deeply understanding the specific inflation mechanics and structural risks attached to every holding in your portfolio. The macro forces of government debt dictate the micro realities of your daily life. Massive federal borrowing applies direct upward pressure on the inflation you feel at the store, the future taxes you owe, and the interest rates on your auto and home loans. Despite this debt load, the US dollar maintains its global dominance because it prices global commodities, drives international trade, and is backed by the world's deepest capital markets. Reserve currency status eventually shifts, but it happens over long historical decades, not a single weekend. You often hear the axiom, cash is king. That is entirely correct when you need emergency liquidity or dry powder during a market crash. But relying on cash as a decades-long saving strategy is mathematically disastrous. The average citizen makes a fatal error in this environment, equating the balance on a bank screen with actual wealth. True wealth is determined by the real goods, services, and future freedom that balance can actively purchase. Navigating this environment is primarily a test of behavioral discipline. To survive, you must ignore media-induced panic headlines and stick to a deliberate, logic-driven strategy. This highly resilient 5-layer framework requires establishing emergency liquidity, productive equities, real assets, monetary hedges, and managing high-interest debt. The middle layers are distinct. Equities capture economic growth, real estate provides inflation sensitivity, and gold acts as a hedge. You have to accurately diagnose the threat. A recession can offer massive repricing opportunities for investors holding liquid capital. Aggressive inflation, conversely, silently and permanently crushes middle-class savers and fixed-income earners. Pay attention to the emotional cycle of investing. Optimism scales into euphoria, then plummets into panic and capitulation. Poor timing and emotional selling consistently destroy wealth much faster than holding a suboptimal asset. Some analysts argue that a massive boom in artificial intelligence and productivity will generate enough revenue to simply outgrow the debt burden. Technological innovation is helpful, but it cannot fully neutralize the mathematics of severe fiscal irresponsibility. You must discard the extreme narratives. The government cannot print money indefinitely without consequence, but a total, apocalyptic systemic collapse is not arriving tomorrow morning. Financial resilience lives exclusively in the balanced middle ground. You build it by rejecting both paralyzing fear and blind complacency, relying strictly on structured logic. For the average worker, the rules for survival are exact. Build your emergency fund, understand the fees and asset allocation inside your retirement accounts, and absolutely kill your high-interest toxic debt before attempting to invest in anything speculative. Modern financial safety is not about avoiding all market drawdowns. It is about structuring your assets so you can survive an economic emergency without derailing your long-term purchasing power. While headlines focus on the $34 trillion debt, your personal risk lies in the structural tendency for the system to devalue savings over time. Cash provides immediate comfort. Productive assets provide long-term compounding. But true mathematical understanding is the only thing that provides ultimate protection.